Good morning, good afternoon, and good evening. Welcome back to the It's Attainable Real Estate Investing Show, episode number 14. Our last show on analyzing real estate investments. Is it a bill, B-I-L-L, or is it a deal, D-E-A-L? We're going to talk in this show about the key indicators of real estate investments. Let's get to it.
Welcome to the It's Attainable Real Estate Investing Show, where you will learn about investing, the power of real estate investing, and how to invest in it. Whether you have the time or even if you don't, you're going to see it's attainable either way. And now your host, who always wants to share knowledge with you, Christopher Balkin.
Before we move into the last of what has become a 4-part series on real estate analyzing real estate assets, determining is it a good deal or is it not a good deal, I just want to do a brief review to catch you up. Certainly, if you haven't listened to or watched episodes 11, 12, and 13, I encourage you to do so. Some good information there on how we got here. But let me do a brief review. You're looking at the deal analyzer. The deal analyzer documents the income and expenses of the real estate asset and allows you to accurately project what your cash flow will be for the real estate asset. So I've broken the deal analyzer into a few sections. The first is income. I highlighted that here. So we've got marked in green the income that the real estate asset brings in. Moving on to yellow shows the mortgage and what comprises the mortgage, which is mostly made up of the purchase price of the real estate asset, but all that turns into principal and interest, monthly payment, times 12 months in a year, making up an annual mortgage total applied to the real estate asset. We look here in orange at the remaining real estate expenses, property tax, insurance, utilities, property management, capital expenditures, maintenance, all things we talked about in detail in the last show, episode number 13. After you subtract your expenses from the income, that leaves you with cash flow. This is important, very important. This is the money in your pocket. These are the dollars that go to the investor or investors, which could be you. In the last show, we saw it was $34,710.40. You'll have to determine if an additional $34,000 is beneficial to you and your family. All right, key indicators. Or maybe we'll call them key performance indicators in lavender. So let's build upon that. So these key indicators that we're going to talk about are going to be based highly on income and expenses. The real estate asset in itself is based on income and expenses. Recall that that's what makes up your cash flow. Your total income, you subtract the expenses, and that gives you your cash flow. Now, as we look here, the gross income for this particular real estate asset was $114,000, largely or all in part from rental or lease income. We talked before that rental or lease income is going to be the majority of the income for a real estate asset. That's no matter whether it's a multifamily apartment building, whether it's a retail store, a restaurant, it's still the same. There's still a tenant or someone who needs to pay the rent or lease to use the space, and then there's the expenses of the property. We discussed before that majority of the income for real estate assets is going to come from rental and lease income. It'll vary a little bit. There may be some additional income depending on the real estate asset, such as a multifamily apartment. Tenants might pay for additional amenities like carports and pet rent and coin laundry if there is any. But by and large, income is mostly going to come from rental and lease payments, whether it's a multifamily apartment building, a shopping mall, a retail store, an industrial factory or park, or a restaurant. All those real estate assets still have a tenant, and the tenant pays rent or a lease payment in order to use the space. So in this example, $114,000 is that income. Gross expenses, and I show here without debt. So The expenses we showed above, principal and interest was included. That's your mortgage. These key indicators are mostly going to exclude the debt from the equation. The reason why is because debt, or the mortgage, really has no factor on the valuation of the real estate asset itself. Certainly, it can be considered an expense because you have to pay the mortgage, and that is a rather large part of the expenses, or it consumes a large part of the income that comes in each month. But one person's mortgage or arrangements of their debt can vary from person to person or property to property. For example, one investor may put 20% down, one may put 25% down, one may put 30% down, one may have a 5% interest rate, or a 4% interest rate, or a 7% interest rate. Because of all those variances, the debt or the mortgage is excluded when evaluating or performing valuations on the real estate asset. We want to value the real estate asset or look at these key indicators regarding the real estate asset on the real estate asset itself. Its true income from rental and lease payments, any additional income, and then its actual operating expenses. So the taxes, insurance, utilities, etc. shown here. So for this particular property, this particular real estate asset, gross expenses without debt or mortgage are $51,600 a year. Expense ratio. So this expense ratio tells us what percent of the expenses, again without debt or mortgage, what percent of the expenses are consuming the income. So $51,600 is 45% of the $114,000 in income. That's the expense ratio. For a multifamily apartment building, and this is going to vary from real estate asset to asset, an industrial park or community may be different than an apartment building. An apartment building might be different than a restaurant, and a restaurant might be different than a shopping mall. But I invest in multifamily apartments, so I know that the expense ratio is typically going to be around 50%, ideally less. We can see in this real estate asset that the expense ratio is 45%. So again, gross expenses without the debt and mortgage, $51,600 consumes 45% of the $114,000 that comes in. So what does all that mean? Well, the expense ratio, we're going to consider this our first key indicator. 45% is a good indicator that this real estate asset is a good deal, that it's operating correctly. If it were 55% or 60% or even greater, there's some indication there that something has gone awry with the real estate asset. Either it's not bringing in enough income and there may be an opportunity to increase the income, or somehow there's too many expenses, or it's costing too much to operate the real estate asset, and there may be an opportunity to decrease the expenses. But as an indicator for multifamily apartment buildings, 50% or a little less are a good indicator. If we looked at this and the real estate asset showed an expense ratio of 15, 20, 25%, that would be an indicator that that may be good, but it's probably an indicator that something's missing. Something is wrong. Something's wrong with the valuation done here. There's some expenses missing, or the income is grossly exaggerated. Something has gone awry with the income expense statement, or what's been given to you, or what's been shown to us for this real estate asset. So 40, 45, 50%, we should be in that range for expenses of the real estate asset. I'm going to mark expense ratio as good, 45%. Why is going to mean good for this show? Net operating income. So what's the net operating income? Gross income minus gross expenses without debt or mortgage is the net operating income, $62,400. So net operating income is just as simple as that. It's going to get used a whole lot as we continue reviewing the indicators here, and it's used greatly in valuing the real estate asset itself. How much is the real estate asset worth? Not how much money does it bring in, not cash flow, not expenses. How much is it worth? The net operating income is going to greatly be used for that. So how do you calculate the net operating income? Again, the gross income, $114,000, minus gross expenses, and gross expenses meaning without debt or the mortgage, brings us to $62,400. There's really no yes or no, good or bad indicator with the net operating income. This is just a portion of the formula or a portion of the math that we're going to use to look at some of the other indicators and also to value the real estate asset. What is it worth? All right, if expense ratio was our first key indicator, then the 2% rule is our second one. The 2% rule, measured in a percent, is simply the ratio between monthly rent for the real estate asset or monthly income for the real estate asset and the purchase price or all-in acquisition price of the real estate asset. So we show here 1.82%. To show the 2% rule with simple math, if a real estate asset costs $100,000 to acquire or to purchase and the income from rent or lease payments or elsewhere were $2,000, that means that this real estate asset or that real estate asset in particular would meet the 2% rule. $2,000 is exactly 2% of $100,000. That's all that rule is. So how do you rate if the real estate asset meets that rule or not? You want to get as close to or equal to the 2% as possible. If you can exceed 2%, that is great, but it's very rare. In the example I gave, we met it with $2,000 being 2% of the $100,000 property. However, in this real estate asset that we have been evaluating, we're at 1.82%. So is that good? I'm going to mark it as a Y. Yes, it is. So we want to get as close to or equal to 2% as possible. Anywhere between 1.5 to 2% is great. And if you go over again, that's even greater, but it's rare. In some areas, the real estate assets are valued at so much or cost so much that some areas call it the 1% rule. But we're not going to rename the rule just because some areas have very high priced or very high value real estate assets. I'm still going to call it the 2% rule. And if you can only meet 1%, well, you have to determine that beyond this rule, is a real estate asset still a good deal? Does it provide you the cash flow that you need for yourself or your family? And how do these other indicators fall in line? Is the expense ratio in line? Is the return on income in line, which we're going to get back to in just a moment? We talked about it in the prior show, but we're going to get back to return on investment in a moment. You see, these indicators are like a team. Individually, they don't mean much, but together, as you review each of these indicators and review them all together, not skipping any one of them, not excluding any one of them, but as you review them all, then you can make a determination on if the real estate asset is a deal or not a deal. And beyond that, how does it compare to other real estate assets or other investments outside of real estate? All right, our third indicator, cap rate. Cap rate is, let me say what cap rate is not. Cap rate is not your return on investment. This shows 11.35%. Some may look at that and say, oh, okay, that's the return on investment. That looks like a number that would be my return on investment, like in the stock market or other type of investments. 11%, some might say that's good. That's a good return on investment. That is not the cap rate. The cap rate is simply the ratio of the net operating income to the purchase price or value of the property. So I'll say it again. The net operating income in comparison to the purchase price or value over the property. So as we look at the formula here in the spreadsheet for cap rate, how do we get to the 11.35%? So I said before, the net operating income is greatly used when it comes to some of these other key indicators and also when it comes to valuing the real estate asset. One of those key indicators that uses the net operating income is the cap rate. The net operating income, which is again income minus expenses, excluding any type of debt or mortgage, $62,400. So we divide that, the $62,400, by the acquisition price or value of the real estate asset, and we get 11.35%. So is that a good or a bad number? Well, the cap rate can also be identified or related to risk. A lower cap rate might mean that an asset is more stable or less risky. And a higher cap rate might mean that the investment is more risky. Now, a lower cap rate percent and a higher cap rate percent is also going to vary in the eyes of the buyer versus the seller. For the seller of the real estate asset or investment, a lower cap rate delivers a higher value, and I'll show you how we get to that. And for the buyer, a higher cap rate delivers a lower value or a lower price. You see, for the buyer, with a higher cap rate meaning potentially more risk, and the lower price is meant to mitigate the risk, it could also mean more opportunity to increase the net operating income to drive up the value of the property. Now, I said a whole lot there, but a whole lot of that was important. Let me repeat that last part. If you increase the net operating income, you're able to drive up the value of the real estate asset or of the investment. If you increase the net operating income, you're able to drive up the value of the real estate asset. If you increase the net operating income, you're able to drive up the value of the real estate asset. This isn't on repeat. There's nothing wrong with the video or the audio. I said that repeatedly because this is another one of those moments where real estate investing is so powerful. Before I get too excited about that, what determines the cap rate? So cap rate is going to vary on multiple influences. Some of it's the economy or the economics. Some of it's going to be the real estate asset itself. So the class of real estate asset in particular. So a shopping mall versus an apartment building versus an industrial park versus a restaurant. The same examples I keep giving, all of those different types of real estate asset classes are typically going to have different cap rates assigned. It also goes deeper within the same class. So you recall episode 7 or 8, I believe it was, where I did a breakdown of the differences between Class A, Class B, Class C, and Class D real estate assets within the multifamily apartment building umbrella. So within the same real estate asset type, there can still be different classes. So a Class A apartment building or a Class B apartment building, a Class C apartment building, those different classes will also typically have different cap rates assigned. Because a Class A apartment building, and certainly go back to episode 7 and 8 and listen to the different types of classes and what makes up the different classes or makes one building a Class A and one a Class C. But just quickly, a Class A apartment building being the best of the best, maybe the best tenants, the best materials, the best amounts of rent or income coming in, compared to a Class D apartment building, maybe having lower rent and income because it's not as well maintained and the materials are falling apart and the building hasn't been kept well, and that's going to be higher risk. So a Class A apartment building would have a lower cap rate typically because it's seen as a lower risk investment, whereas a Class C or D apartment building will be assigned a higher cap rate because it's seen as a higher risk investment. Increasing the net operating income can increase the value of the real estate asset. I repeated that multiple times. So how do you do that? It's natural or forced appreciation. In episode 5, I talked about natural versus forced appreciation and what is that. So appreciation is how a real estate asset typically increases in value year over year. There's things you can do to force that. So as you force appreciation, the value of the real estate asset goes up. Now, when we look at net operating income, it's made up of what? Gross income and expenses. So if we can increase income or decrease expenses, just simple adding and subtraction shows you that the net operating income will go up. Let's take a look at some cap rates. I've shown some here on the right. Cap rates ranging from 4% to 12%, all based on the same real estate asset. This real estate asset with a net operating income of $62,400. So I mentioned in episode, I believe it was 7 or 8, when I broke down the real estate assets, A, B, C, and D, for example, for multifamily apartment buildings, that if you can take a real estate asset from D to C or C to B, or maybe even from B to A, and I also just stated that the cap rates on a higher class real estate asset, such as a Class A, will be lower than the cap rate on, let's say, for example, a Class C or D apartment building or real estate asset. You can see here that a Class C apartment building will say, for example, again, this is going to vary on the economy, on the region, on the market, on the neighborhood. It's going to vary, and then also on the real estate asset. But if this 8% was a Class C apartment, and maybe we were able to make it a Class B apartment, and again, this is going to vary from market to market, area to area, region to region, class to class, neighborhood to neighborhood. It's all going to vary. But in this example, let's say that the cap rate in a particular region or neighborhood or area was 8% for a Class C apartment building and 7% for a Class B. We can see that if we're able to make that change in the apartment building from Class C to Class B, and I'll get to how in a moment, the value of that real estate asset has increased from $780,000 to $891,000, $110,000. The real estate asset has increased in value. Let's stick with this 8% for a moment. Remember, 8% equals a value of $780,000. Let's just keep our mind on that for a moment. And let's go back and look at the income of this real estate asset. We said this was a 10-unit apartment building. I've got 10 here, and it brings in $10,000 in rent. So 10 units times $1,000 each equals $10,000 a month in lease or rental payments. Let's say that you increase the rent a modest $25 per month. So the rent went from $10,000 per month to $10,250 per month, or $3,000 a year. So 250 times 12 months in a year equals $3,000. If we go back and look at the cap rate, I'm going to scroll down here, and because the cap rate is made up of, you know it by now, the net operating income, we increased the net operating income because we did what? We increased the income or the gross income of the real estate asset. The value of the property from a modest $25 per month per unit, or $250 per month for the 10 units, or a total of $3,000 per year, the value of the property has gone from $780,000 to $808,000. That small increase, seemingly small increase, has increased the value of the real estate asset by $28,000. So why would you increase the rent by $25? There's a few reasons. One may just be that the seller or the current owner or the current investor, the person that you are acquiring the real estate asset from, maybe the rent or the leases were not equal to the fair market rent in the surrounding community or neighborhood. So similar real estate assets or a similar apartment home, similar square footage, similar finishes, similar quality, the rent was $1,025. So by simply matching your real estate asset or your investment to those surrounding your investment or your real estate asset, you've increased the value of the real estate asset. You've increased the value of your investment. Secondly, when we look at what $25 is in comparison to $1,000, it's about 2.5%, or it is 2.5%. It's not uncommon for rent to go up in many places around the world 2 to 3% per year. In some areas, at a much faster pace, much higher than that. But in this example, for this real estate asset, 2.5% or 2 to 3% is $20 to $30. So that's not uncommon for the apartment homes to increase in rent yearly or periodically by 2 to 3%. So each 2 to 3%, you can see what that does in terms of the value of the real estate asset. In this case, it increased it by $28,000. Both of those are more so examples of natural appreciation, just real estate typically increasing in value year over year. Now, the other reason that an investor might increase the rents is from forced appreciation, natural, occurring naturally. As the economy goes, as supply and demand changes, that will or could allow real estate assets to increase in value year over year. Naturally, we call it. But forced appreciation is when you do something to increase the value of the real estate asset. So doing something forcefully to increase the income or decrease expenses. In episode 5, I talked a lot about forced appreciation. And now here in episode number 14, you get to see what that forced appreciation does for you. If just $25 increased the value of this real estate asset by $28,000, what would $50 or $100 or $150 in increased rents per unit do to the value of the real estate asset? When I talked about moving the real estate asset from a Class C to a Class B, the value of the property increased by over $100,000. Well, how do you do that? Episode 5 explains it more, but in summary, renovations to the apartment homes or the building itself or adding amenities. If you travel from time to time and you compare hotels at your destination or your planned destination, you'll see sometimes that a nicer or more renovated or a hotel that has more amenities will cost more than a hotel that has been maybe well maintained, but it doesn't have the amenities. Maybe it doesn't have a swimming pool, or the fitness center is smaller. And though the hotel room may be okay, it's not as modern compared to other hotel rooms that cost more per night. You see, real estate investing can be similar, especially multifamily apartment buildings or real estate assets where apartment homes are rented or leased by tenants. Depending on the area, people will pay for a nicer place to stay. And if you're able to invest in providing them a nicer place to stay, you will be handsomely rewarded with more income and a much higher value applied to your real estate asset. So what do you do with the value? What do you do with this newfound or increased value? Well, episode 5, I talked about selling. In episode 6, I talked about refinancing. So if you acquire this real estate asset for $500,000 or $550,000, and now it's valued at $808,000 if it's still considered Class B, or maybe $924,000 if it's considered Class B, and you sell the property, that's a profit of $300,000 or $400,000. If $34,000 in additional income from cash flow from the real estate asset was helpful to you and your family, what will $200,000, $300,000, or $400,000 do for you and your family? The synopsis of my show says, listen and watch the shows for transparent knowledge sharing on investing and the powerful impact real estate investing can have on your wealth and your lifestyle. The powerful impact real estate investing can have on your wealth and your lifestyle. Is this powerful? Taking a real estate asset from $550,000 in purchasing to $900,000 in value? Is that powerful? What will you do with that amount of additional dollars for you and your family? Well, you don't have to sell the real estate asset in order to get those dollars. In episode 6, I talked about doing a cash out refinance where you can refinance the real estate asset based on this new value of, for example, $924,000. The bank will give you a portion of that, say 70, 75, 80%. That will still leave you with a modest $100,000 to $150,000 for you to collect, or even better, reinvest into the next real estate asset, and then also keep this real estate asset. It's just a circle. You take the proceeds from one real estate asset and reinvest it in the next, and the next, and the next, until you've met all the goals for yourself and for your family. All right, we got to move on. Just a few more things. Cash on cash return. This is your return on investment. I said before, it's simply what you get back for the dollars that you put in. So measured annually, this real estate asset provides a 26.9% return on investment, or cash on cash return it's called, because it's the cash that you took out of your pocket and put in as an investment into the real estate asset. So never mind what the bank provided. The bank's money is not your money. The bank's money is their money. So this is a cash on cash return because it's the measure of the dollars of the cash that you put into the investment and what you get back. So breaking down the formula or the math for this, it's still pretty simple. Measured annually, so we look at our cash flow. Now $37,000, since we increased the rent slightly, divided by the $137,500, or 25% of the acquisition or purchase price, provides 26.9%. I guess it's okay to round that to 27%. So where else are you getting those type of returns? Do you have any other investments that are providing you a 26 or 27 or 20 anything percent return on your investment? If so, stick with it. If not, then let's talk about the investment opportunities that might be available to you with real estate. I think it's okay for me to go ahead and put a Y next to the cash on cash return. I think this passed the indicator test. 26% or 27% or 20 anything percent is pretty good for any type of investment that's available today. And for cap rate, I didn't put a yes or no there. It depends on the market. It depends on the region. If the market is, say, a 8% like what we talked about, if that's what is assigned to the type of real estate asset and the real estate class that you're investing in, and you purchase it at an 11% cap rate, which is what has been done here, 11.77%, then I would say yes, that's good. But it could come with risk because remember, cap rate is also the assignment of risk potentially to the real estate asset or to the real estate investment. But with risk can bring opportunity. So I'm going to put a Y here for yes. This passes the indicator because the cap rate for the area or the type of class of real estate investment or real estate asset is 8%, and this exceeds that at 11%. And I'm the buyer, I'm not the seller. If I'm the seller, I certainly wouldn't want to sell at this cap rate, but I'm the buyer, and I feel good about this opportunity. And besides just this one indicator, my other indicators are looking pretty good here too, because it's a team of indicators, not just one all by itself. As we come down to our last couple of indicators, debt service coverage ratio, sometimes referred to as DCR or DSCR, just debt coverage ratio. This is the ratio of net operating income in comparison to the principal and interest payments for an entire year. To provide you a simple example, if a mortgage were $1,000 for the year, so principal and interest payments total to $1,000 for a year. Don't get excited, this is just an example. Not too many mortgages are going to be $1,000 for the entire year. But in this example, $1,000 for the entire year, and your rental income or the income for the particular property or the real estate asset was also $1,000 per year, then the debt service coverage ratio would be 1. If the mortgage was $1,000 for the year and the income was $750 for the year, then the debt service coverage ratio would be 0.75. That means that the income would not pay the mortgage for the year. The income for the property or the net operating income after expenses would not pay the mortgage for the year. That's not a good thing, and a bank will not approve that loan. The bank is not going to give you a mortgage or a loan when, upon analyzing, like we've done here in the deal analyzer, shows that you cannot make the payments for the mortgage. Now, if the same property had a mortgage of $1,000 per year in mortgage payments, and the net operating income, the income after expenses, were $2,000, then you would have a debt service coverage ratio of 2. And almost any bank will give you a mortgage for that loan. Now remember, this is just one indicator, so the bank may have other criteria as well. But in terms of debt service coverage ratio, 2 would be awesome for the bank to see. The bank will typically want to see a 1.2 to 1.25, maybe 1.3 debt service coverage ratio. That means that your net operating income will pay the mortgage and you'll have some left over for yourself. In this example of this real estate asset that we've been analyzing, the debt service coverage ratio is 2.34. So the net operating income is double the mortgage annual payments and some. Moving on to our last key indicator, debt yield. Debt yield is a key indicator referenced by banks, and it shows the ratio of net operating income to the loan amount that the bank is giving you. So if the acquisition or the purchase price is $550,000 and the loan to value is 75%, then that leaves $412,500 as the loan amount. And that is what this ratio is in comparison to. The net operating income divided by the loan that the bank is expressing to you. In the analyzing of this real estate asset, the debt yield is 15.69%. $64,710 in net operating income divided by $412,500 equals 15.69%. So the lender or the bank that I deal with typically likes to see 9.25%. I believe that's what it was, 9.25, 9.75. I believe it was 9.25% debt yield. So this particular real estate asset, this opportunity exceeds that. So they'll be more than happy to do this loan or to support us in this real estate asset investment. So we'll go ahead and mark a Y for debt service coverage ratio and a Y also for debt yield for this real estate opportunity. And as we look at the key indicators here, it looks like these are all pretty good. And if the cash on cash return, your return on investment meets your goals, and the cash flow or the income from the potential real estate asset also meets your goals, then this looks pretty good for you. And you proceed with the acquisition of the real estate asset. Over the last few shows, I've shown you how to analyze real estate assets or potential real estate assets or investments. You want to make sure you're investing in a deal, D-E-A-L, and not a bill, B-I-L-L. While a bill will bring additional liability and expenses to your life, a deal, well, investing in a deal is what pays those bills and those expenses. And that is a pathway to financial freedom or a supplemental income for you and your loved ones. Also, from these last few deal analyzing shows, you should be able to compare real estate investments alike to see if they're a good investment for you, to see if they fit into your goals and your strategies and your plans. And also comparing real estate investments to investments that are not like, such as the stock market or other business ventures that might be available to you. If you have questions about this show or any other show, you can reach me at neelyrealty.com/podcast. That's NILEE realty.com/podcast. Click the button and ask your question or leave a comment and I'll get back to you. Lastly, if you found these shows helpful to you, don't keep it to yourself. Share the shows with someone else, and I'll see them and I'll see you back here next time as you continue to learn just how attainable real estate investing is to you.
You have been listening to the It's Attainable Real Estate Investing Show, sharing transparent knowledge on investing and the powerful impact real estate investing can have on your wealth and lifestyle. Follow or subscribe to the show using your favorite podcast app so you'll know firsthand when a new show is released, or visit neelyrealty.com/podcast and see the show there. That's NILEE realty.com/podcast.